Well, once again, many thanks, and thanks for inviting me to do this talk today. Hi, everyone. Look, Nikki's done me a great introduction as to what my background is. I'm a licensed insolvency practitioner. I tend to see the worst situations for most businesses. And that's a little unfortunate because it does tend to give me a little bit of gallows humor in the way that I approach things. But actually, that's not a bad thing either. And I think it's really important that whatever's happening in the world around us, we've got to try and keep our head high. We've got to try and keep a broad vision on things. We've got to try and stay as positive as possible. I take a middle line. I remain pragmatic about most things. If things happen, they happen. Deal with them, get on with it, and don't actually keep looking over your shoulder. So that's the main thing. So, look, yeah, I've been doing this job for well over 20 odd years as an insolvency practitioner, well over 40 years now as a business advisor generally. And oddly, probably the most dramatic experience in my life within this profession was in 2008. And the financial crash of 2008, we never thought we'd seen anything like it before. And genuinely, it was the first time I'd really experienced a financial crisis in the UK, or perhaps globally, that was particularly far-reaching. Until then, I'd seen a number of recessions. I knew what to expect. 2008 changed all the rules. And then there was a dull time. It was very flat. The marketplace was really quite static for a long, long time on all fronts. Businesses were thriving in some areas. In other areas, they were sat in the doldrums. So in 2020, when I was doing a presentation on the basically business confidence as much as anything else, and my presentation was not about statistics. It was about where do we find ourselves now? And there was an awful lot of talk about zombie businesses and where is the economy heading? And in February 2020, when I was assisting and presenting some quarterly statistics, I made mention of something that might have a due impact on us. There was a little virus going around China. It was affecting the Chinese stock exchange. So just watch that marker, watch that place marker. Within a month, I'd suffered COVID myself, and we all know where we went after that. Now, I'm not going to mention COVID much more in this presentation, you'll be pleased to know, because it's not actually the cause of all our problems. It's just happened to act as a catalyst for where we are right now. And I'm going to take a fairly, I say a light-hearted view, but also quite serious in terms of its intent as to how we proceed with this. So forgive me, but I'm going to start with a quotation for you. I quite like this one because this is a quotation from Charles Dickens. And I will read it. I think it works if you read it. It works a lot better. From A Tale of Two Cities. He wrote this in 1859, and he was making reference to France of 1775. It was the best of times. It was the worst of times. It was the age of wisdom. It was the age of foolishness. It was the epoch of belief. It was the epoch of incredulity. It was the season of light. It was the season of darkness. It was the spring of hope. It was the winter of despair. We had everything before us. We had nothing before us. We were all going direct to heaven. We were all going direct the other way. In short, the period was so far like the present period that some of its noisiest authorities insisted on its being received for good or evil in the superlative degree of comparison only. Now, forgive me, a lot of Victorian language in there. What I really found interesting about that is that in 1859, Charles Dickens was talking about 1775 and making a comparison between those two periods, 70 odd years apart, 80 odd years apart. So I looked at that and thought, well, actually, that's not that different to where we are now. History does repeat itself. And if you've been looking at where the UK was in terms of its political situation, where the world has been politically over the last few years, and where it's been as a result of the pandemic, and various other instances have arisen in and amongst, you'd be forgiven for thinking that the whole world was completely utterly topsy-turvy, because things never are quite as they seem. And the only way you can really gauge where things are is by understanding your own experience, and understanding your own experience within the context of everything else. So you need to understand everything else that's around you. Having business certainty is really, really critical to running your own business. But also it's important to block out some of that background noise. Don't just follow the herd. Actually look at your own business in context, look at your own position in context, and take advice and join groups and talk to people about what's happening around you. So make sure that your perception is the right perception of where you are at any point in time. The moral of the Tale of Two Cities, of course, was that things aren't always as they seem. And I think that's the point of Charles Dickens' comments in the opening paragraphs there of A Tale of Two Cities. Now, technology and information seem to drive every decision we make in our lives. Certainly it does within our businesses. But whenever I meet a new client, and generally they're in crisis at the time, the first thing I do is help them to assess their own situation without those influences. We put the scary monsters in the corner of the room. Literally, sometimes I point to the corner of the room and say, it's gone there now. And we talk about where they are. What was the journey they were on when the problem arose? How did they actually come to choose that journey? Was the destination one that appealed, or was it was a mystery tour? They just happened to be there. It happened to them. What did they do to get themselves ready for the journey if they did intend to go on it? And did they carry the right sort of kit for the journey? Were they equipped for it? Now, I think it's really important, as I've really sort of alluded to at the opening here, we've got to take stock of our situation, but we've got to be realistic about it. We've got to think about the financials. We've got to think about the business that we know and we understand. And we've got to talk to other people within our industry and within associated businesses and look at the economy around us and just to see how these things are currently affecting us. But it's really, really important that you don't forget the weight of your experience. And that's all your experience. The experience of the journey you've taken, it's the experience of your life, it's an understanding of your own personality and how you perceive things, and also the personalities of the colleagues around you and how they perceive things. We talk a lot about teamwork, and some of us don't have teams. We don't have teams within our business. Some of us work alone. But those of us who do have teams, it's really important that you share between you some of your experiences so you kind of understand where each of you is coming from. Because if you collaborate as a team to take a business forward and to be resilient within that business, you sort of have to have a bit of understanding about your collective weight of experience. So I always talk to my clients about their experiences before I start to deal with the problem that's actually on the table. And in terms of preparing ourselves, well, again, with my clients, I always prepare them for the journey that I'm about to take them on. I want to make sure that they're happy with that journey, that the equipment they're taking on that journey is equipment that they understand, they know how to use, and that they're prepared to use that journey. And it should be the same whether your business is in crisis or not. It's all about preparing yourself for the journey. Now, I don't want to be flippant about this. It's much, much more complex than this. And I can be really incisive about things when you need me to be. But we've got about 35 minutes or so left for us to go through this. And if we were to go through this in detail, we'd be here 2 days a week for the next 5 weeks, no problem at all. So basically, I've an action point for you. Evaluate your historic journey. That's all your journey, business and personal. What do you think you can have or have already learned from it that will significantly impact your business future? Now, let's move on a little bit to where we are now. Full employment, resources, geopolitical uncertainty, upheaval, the environment, information. Number of things on there which will hopefully immediately chime with where you're at the moment. In other words, this is what the UK economy, the worldwide economy, is experiencing. Full employment. Who'd have thought it? You know, most previous recessions that we've seen in the UK, all those that I've experienced, have generally involved very low employment levels, high levels of unemployment. But we've got full employment. And one of the reasons we've got that is because we have so many more capacities in which people work, so much more diversification. So the UK as a country now, compared to what it was in the 1980s, is so dramatically different that they're almost beyond comparison. Now, resources, we seem to be short of resources. We can't get the things that we need. And we know that that's a combination of the impact of the pandemic, ships running aground in the Suez Canal, and of course, the war in Ukraine, and general geopolitical problems, people just don't seem to want to work and cooperate universally at the moment within the world. We might want to do it locally, but no matter how much we try to do it, it's very, very difficult to do it. And unfortunately, for good or evil, maybe, the pandemic has forced many of us either to become more self-sufficient, or alternatively, it has driven this process of working and collaborating remotely with people, and that's with suppliers and with manufacturers and producers, and also with our own personnel, to the point that we are very, very fragmented in how we operate. So those of us who are specialists have become hyper specialists at what we do in every aspect of business, whether that's manufacturing, retailing, you name it, business services. We've all become hyper specialists. And the downside potentially of that is resource management, whether it be physical resources and also employee resources. So again, if you've got teams of people, we're all struggling to recruit the right people to do the right job to service the needs of our clients. And that has really put additional pressure on our business. The environment, the constant discussion about the environment and the cost of the environment and the cost of our businesses to the environment is always there. And then right at the bottom of the list, there are more things we could say, but one of the other things is information. There is perhaps in some respects too much information for us to consume, to evaluate, but still deal with the incredibly busy business lives that we have. So against that background, you've sort of got to still focus on your own business. So it's important to be centered and grounded about things. You're either confident about your business and what you do, or you're not. But I suspect that most of us are very confident about our own abilities to do what we profess to be experts at. We just don't have enough confidence around us now with all the things that we rely on to support our business. And that has really undermined business at large over the last 12, 18 months in particular. Now, at the moment, our big problem is recession, it's inflation. And the worry is that perhaps money isn't going to be worth as much as it used to be. And a little image on the right-hand side there, for those who remember Jessie J and the money tree. And she says, it's not about the money, money, money. We don't want your money, money, money. We just want to make the world dance. Forget about the price tag. And I've always liked that song because actually it's not about the money. It's about much more than money. Money is just a route to something else. But without it, our businesses won't thrive. And inflation and recession always seems to be focused on cash, hard cash, money in supply, etc. Well, I take a view that what we're dealing with now is much more about scarce resources, whether it's employees, whether it's materials, whether it's actually the ability to do things within the time that we've got available. So we don't have enough time available either to do what we need to do because of all the complications. Now, if you are looking to build, create and sustain financial resilience in your business, you want to avoid insolvency above and beyond all else. And as an insolvency practitioner, the first thing I try to help my clients to do is to avoid insolvency. So for you, assuming you're not in that region at this point in time, but you do have worries, then you want to avoid insolvency. And actually, I take the view that not cash, but liquidity is the key issue here. Now, liquidity is important to all of these things. If you haven't got access to the finances, not necessarily the money, but the finances and the financial resources within your business to get the raw materials you need at the prices you need, it's a problem. If investment yields are low for people who are in that marketplace, then they don't have the yield out of that, which effectively is the liquidity, to do the other things they need to do, to reinvest, to do repairs, or even potentially to look after their future, thinking about the pensions market, etc. Resources, again, if you want resources, you've got to have liquidity. There are so many calls on your business that at the moment, if you don't have that liquidity, then you can't effectively push those resources around. You're static. You can't grow resources, you can't reduce resources. Everything is in a fixed space, and that's not good for business. And your existing borrowings, they're becoming more expensive. That's using up more of your resources as well, your cash resources, yes. But again, it's about liquidity. Because if those borrowings are using up more of your cash, then how liquid are your other assets? How quickly can you turn them into cash to actually fill the financial gap that the existing borrowings are creating for you? And your overheads, increasing materials, increasing energy costs, increasing employment costs. All of these things are putting extra pressure on your business. And without resilience, your business is only likely to head in one direction. It'll stagnate and eventually risks failing. And of course, you want to avoid that. So liquidity and the ability to be flexible with everything within your business is more important than simple hard cash, because simple hard cash over time will reduce in value. So liquidity is more important. It's the old argument that actually, turnover sometimes can be vanity. Profit is what you need to be going for. And a smaller business that has downsized can remain as profitable or potentially be more profitable than a big booming business. And this idea that growth is everything isn't necessarily always the case, particularly in an economy where we've got inflation and recession. So business finance is what it's really about. It's access to finance, access to liquidity. If you don't have it within your business, then where can you get that access? And that's what I'm about to go through now, with a bit of a broad brush. I'm afraid we don't have time to cover this in as much detail as I would really like, but we can cover enough, I think, to give you some ideas of places that you might go to look for the funding that you require if you don't already have it. So what are the needs for the business? Well, we need money to stay on track. Fundamental importance of forecast, projection, and KPIs. You need to understand by doing forecasts, projections, and having these key indicators in your business to understand how your business is moving financially. Is it heading in the right direction? Are there pitfalls ahead that you need to be aware of? And if you can have these projections and forecasts, they don't have to be too detailed. You just need to have something that is other than your experience today. It's what does next week look like? What does the week after look like? Not just what are sales like, but what about the finance necessary to fund and manage those sales? And covering off the what ifs in your business. What if there is a bout of illness around the firm? What do you do if people have to go on leave? What do you do if certain materials cannot be acquired? So you need to also improve operational performance, and you might want to obtain finance to improve your operational performance. That's to fund efficiencies. If you can actually make your business more efficient, then you can suffer some of the financial pitfalls that the future might hold. But sometimes it takes cash, it takes an injection of money, putting money into the business to actually improve operational performance. And you've got to do that balancing act of, is it worth spending that money now to achieve those efficiencies to make sure that your business is more resilient for the future? And then the longer term objectives. The little piggy bank there suggests that you've got the long-term acquisition of bigger things. I mean, that reminds me of me buying my house back in the 1980s, my first house, when I was paying interest rates of 15% at one point in time. I was spending over 80% of my monthly salary on my mortgage payments back in the 1980s. And then research and attract more profitable and sustainable business. You need money to do the research sometimes. So to attract more profitable business, you need to find it, and you need to spend money on developing more profitable business. So all of this involves spare resources that you might not have at the moment. So the trick to resilience is to put yourself in due course, not now, not tomorrow, but in due course, build a course to having a position where you can actually move resources around, move funds around, and be able to actually make decisions as to where you want to spend money in the short term to achieve other improvements. So it's not all about getting bigger. It's about using the same resources differently to achieve different results. Boosting sales, yeah, you can always spend money to boost sales. I still take the view that unless you're really sure about your business, boosting sales on its own is not the cure to everything. And I deal with a lot of clients as an insolvency practitioner who have boosted sales and then found that their business cannot sustain them. It cannot even afford to service the sales. And that is probably the most, it's probably the most upsetting situation to see, when you can see a really potentially very successful business with a good product fail because it has driven its business too fast. It has effectively overtraded. And then financing, recruitment and employment. Wow, is that a big problem at the moment? Getting people into the marketplace, getting people from the marketplace to your business rather than to one of your competitors, and retaining people, and not just spending loads of money on recruiting, then training, and losing people to your competitors and somebody else who can afford to pay more money. It's really is a problem. So building teams that are resilient is another feature that we should really bear in mind for the future. It's not just about the money. So that's basically an overview of business finance, what we'd use it for. But I now look at different types of finance. Now, equity finance is an interesting one. You may already share ownership of your business. It might be you and a few people. It could actually be a much larger group of people. I used to own my own business. One of the reasons I'm now with Xeinadin is because I recognized that this was a way of making my business, the bit that I run, more resilient. So I joined Xeinadin on the basis that we're a much bigger organization. We're a national organization, 100 plus officers. I'm a small part of what is now their recovery service line. And I've accepted some backseat on the driving forward of the business in order to become part of that. But for the benefit of my colleagues around me, my partners, and also my colleagues that I employ who've been with me for many years, to make sure that they've got a longer term future and that our business is more resilient as the world changes. So you may already share ownership of your business, but I wonder how many people do it for financial reasons. So many of us just sort of fall into that position. We need friends around us, so we do it for that reason. But equity finance is interesting. There are lots of different ways you can go into equity finance. That's looking for venture capital partners, so people actually coming to you and investing in your business with capital for a specific project, or potentially coming in and giving you funding and supervising your use of that funding to take you to a position where you can potentially sell that business and everybody gets the money back out again. Now, it's a very simplistic way of looking at venture capital, but that is basically it. You get venture partners. They have got the resource to put in. They are investors. They're professional investors by and large, and they expect to get an exit route at some point in time. And their exit route comes from selling the business or selling something that you have with them developed to a point where it becomes more valuable and you can get the financial resources back out of it. Obviously, family, friends, employees, and cooperatives are an obvious one. And I think that probably is closest to where most of us will be with our businesses when we first start and we grow the business in terms of having partners and colleagues around us. Another area of finance on the equity side is crowd or crowdfunding. And that has now been around for a number of years, certainly driven by the internet. In no way could it have happened really to any great degree until the internet came along. And our ability to communicate with people globally and to touch the lives of people who don't know about us and couldn't know about us without the internet is really important from a point of view of getting people to understand what we do and support what we do, follow what we do, and be so interested in it that they actually wish to support us in some of the projects that we do. And you see a lot of things like craft breweries, for example. Many of the craft breweries have become very, very popular and they have a following. And I've seen a number of craft breweries that have actually managed to fund their businesses through crowdfunding. They've managed to develop their businesses. And when they couldn't raise commercial finance from banks or whatever, then they were able to get funding from people who really had a faith in what they were doing and how they were doing it. And an awful lot of environmental projects are cloud or crowd funded, which is really, really interesting. And I've just noticed I cannot spell crowd. So apologies to everybody there. Investors. Now, these tend to be individual investors. They might be angels. They're not necessarily venture capitalists. These are people who see that you've got a project that they want to invest in and they can see a way of putting their money in on the basis they will probably at a future date get their investment back out as capital. But in the meantime, they will also get a return on that investment. And that's another route to look at equity finance. Now, equity finance is an area that's very difficult to go into on your own. You can do a lot of research around it, but there are specialists out there who can introduce you to equity finance that's suitable for your business. So whilst I'm mentioning all these things, you'll almost certainly need to actually talk to a professional advisor, an accountant, or an asset-based lending specialist to look at the different opportunities that are available for you in this particular marketplace. What is important to know, though, is if you go with equity finance, you are probably losing some control over your business. Anybody who's putting large amounts of money into your business will expect to have a degree of control over it. So do bear that in mind. You may find that you have oversight, people looking at what you do in much more detail, because in all fairness, you are spending their money and they're generally investing it because they hope to have a return on it. So getting in there, because they effectively become part of your business, they often take shares in your business. Getting in there can sometimes be harder to get out. So it's very, very important that the decision to go through an equity finance process is something that isn't taken lightly, and you are guided through it by somebody who understands the process and can also explain some of the detail to you along the way. Now, debt and capital finance, that's my terminology, but this really is about asset-based lending. So amongst this, we've got things like bank loans and overdrafts. Now, bank loans and overdrafts, are they asset-based? Well, asset-based because by and large, it's very difficult to get a bank loan or an overdraft now at all. But if you do, then generally you're going to get that through giving a personal guarantee, or you may also be giving security over the company in the form of a debenture or a mortgage over the company's assets. But it's the most typical way that people get finance in a small company. But then you've got asset-based borrowing. And if your company's actually got some assets, physical assets, and that can include things like its book debt ledger. So if you've got outstanding debtors, people who owe you money, you can use that to finance the business. So asset-based borrowing is probably the biggest and foremost single route to finance after bank loans and overdrafts. And quite often banks who don't want to give a bank loan or give an overdraft will introduce you to their asset-based lending team, who will effectively look at whether or not they might be able to finance your business through the debtor book. So the money that you're due in, if you give credit, that money is sat out there for 30, 60, 90, maybe even 120 days, depending on what sort of industry you're in. You may be able to get money against that from a specialist lender, and they will take the asset as security for that lending. Again, very specialist area, but there are lots of brokers out there, as well as banks, who can give you some guidance on that. But I would always recommend the first place to call is to your accountant or your general professional advisor for a bit of guidance on who they would recommend that you talk to around those sort of things. Asset finance and leasing, I think we're all probably pretty familiar with this. If you get yourself a car these days, it's very rare that people buy cars for cash, or if you buy a van, you will more than likely get this on either leasing or on a hire purchase, or if you're an individual, on a PCP type contract. It's very similar to that in terms of how you might deal with plant and equipment. And again, a lot of people will buy engineering equipment on that base, and you will all be very familiar with it. So I won't go into that in too much detail here. Trade finance, that is another form of asset-based borrowing. I've really already mentioned this, but trade finance is effectively, there's two aspects to it. On the one side, there is you, if you are a supplier or a manufacturer, you may give finance or credit to your customers. You will let them pay you back in 30 or 60 days, whatever it might be. Now, that is straightforward trade finance. And if you are a borrower of trade finance, in other words, you take credit from a supplier, then it's no different to any other borrowing. Your obligations to the person who's provided the goods that you haven't yet paid for is the same as if you'd taken money out of the bank that wasn't there. So if you borrow money from the bank on an overdraft, you've effectively borrowed money in the form of assets from the party who supplied you with materials. So it's really important to bear in mind that trade finance shouldn't be disregarded as a form of borrowing. It is still a form of borrowing. And similarly, if you actually supply goods to a third party, but you don't expect payment straight away, then again, that party becomes obligated to you, and the fact they owe you money is something you can borrow against. And that, again, is the main reason why most people go to factors and discounters in order to get money in advance of your debtors, the people who owe you money, paying you. Now, general credit lines are available in all sorts of different businesses. Again, that's a form of trade finance. These are all different terms that pretty much describe the same sort of things. And then towards the bottom of this list, I've got credit insurance. Now, credit insurance is a way of protecting yourself against bad debts. It can be worthwhile. It can be very, very worthwhile. And quite a few forms of asset-based and trade finance deals include credit insurance as part of the process. If you're looking at invoice discounting or factoring, then it's quite often that credit insurance is one of the things you might have introduced to you by the bank or the lender that is providing that facility for you. And it is very useful. It can be expensive, but there are times when it is absolutely invaluable. Always worth thinking about, and always worth wondering whether it's worth building the cost of that insurance into your financial model. So one of the action points here is, what aspects of your business could benefit from commercial finance? Would you know where to find the right financial advice? Would you speak to your bank, your accountant, or a broker? And even if you don't currently think that you want or need commercial finance, you really need to consider the potential benefits for your business. Ready access to a source of pre-approved credit means that you have additional liquidity. The trick is then to be wise in your use of it. So what I'm suggesting here is be aware of these things, be aware of where you might get the advice for them. If you don't need it now, then in order to be resilient, you need to be ready for the use of it if you require it. You need to understand the various things that are out there, and spending time now to do that would be a really good idea as we look at heading into a recession. It may be that you can get pre-approved for credit right now. You might be in a better position than somebody who hasn't been pre-approved and then finds that when they need the finance, it's almost impossible to get it. So the what ifs, whys and wherefores of finance for business. Well, as the little jars in the corner there might suggest, if you've got dwindling resources, your savings are dissipating, then you're losing resilience. And too often clients come to me when they're borrowing their way out of trouble, or when they've already borrowed their way out of trouble and the trouble has not gone away. They've just abated it for a while. The answer is to perhaps do some borrowing, but doing it sensibly, whilst tracking the journey that trouble is making. Is it really going out of the door for good, or are you just simply digging the hole deeper? And it's really important that you understand your business before you get into that stage of operation, because when you start to borrow out of need, you often don't have the time to actually take a view on whether or not it's the right thing to do. Is it really necessary to do the borrowing? Is it really necessary to take those steps? Or could you actually find some other way of resolving your business problem? But all too often I meet people who come to me and say, well, I borrowed this money because I needed it. And I do take them back on the journey and say, well, what did you need it for? And then realize that actually what they needed it for was something that was perhaps ill-planned or was no longer the route that they should be taking in any case. But it was already too late. They borrowed the money and they had to repay it, and the business is no longer in a position to repay it. So you've got to look at the real potential cost of borrowing as well, and you've got to get the right mix of funding. There's no necessarily one source of funding that fits. You could use a number of ranges of financing your business. And again, this is why it's important to look at all the various sources of finance, finding the right finance for your business, and being prepared to take that route if you need to. Because when borrowing goes wrong, it goes wrong big style. By and large, when a business gets into financial difficulty, if every opportunity to borrow has been taken, but without any real thought for what the exit route is, then it goes horribly wrong and is almost certainly going to head towards insolvency. And it is always, to me, the most upsetting situation to see, where I know that if I'd been consulted sooner, as an insolvency practitioner, I could have given the guidance to avoid the business going into insolvency, or could have given the breathing space to the business to enable them to actually review the right sort of finance that would have helped them to find their way forward. So really, at the end of the day, I'm saying get yourself informed and keep yourself informed. Online seminars like this can be a fantastic way of staying connected. There can be some advantage in the anonymity of it. I can't see your faces. I can talk for quite a while, as you can probably gather. But if your business is under stress, you still need to talk to people. But when your business is under stress, quite often what you do is take a bunker mentality. So creating a network is really, really important. You need a network of support, both internally and externally to your business. So attending business forums is absolutely critical. Being part of business forums is fundamental to a healthy business. Chambers of Commerce shouldn't be discounted. They do run some good courses, they do create some good networking events, and they do get people together just to share experiences, because knowing that your problems aren't unique to you can be really, really important in terms of giving you a degree of peace of mind. Don't take it as cold comfort, but understanding that other people do have the same problems and that they do know how to overcome those problems, and also being able to discuss with them, hopefully on a confidential basis, how they've resolved their problems, just will give you a bit of guidance, may give you a bit of guidance towards how you could resolve your own issues. So networks, marketing networks and clubs, business networks, luncheons, all sorts of things that can just get you out there to meet other people, aside from your own customers and your own personnel, and perhaps even your own business partners, are really, really important. Lift your head up, look beyond the realms of your own business, even look beyond the realms of your own industry, but talk to other people. All networks will give you something positive to think about. And use local intelligence. There's a lot of local information to be found amongst the business community. And do watch the internet, do get yourself involved in Facebook, do use LinkedIn. All of these things potentially could be very, very useful to you. And always look on the bright side of life. This kind of ends my presentation where I started. I started with Charles Dickens looking at the world from two different perspectives 100 years plus ago. And if we now look at where we're at, we've gone through some really silly times. We've seen some silly things happening in the UK economy, some really silly things happening in the UK politics. And it doesn't matter what sort of politics you have, it hasn't been well handled. And we've all suffered as a result. So that's been without particularly critical of one organisation or another. All these things have been outside of our capacity to do much about them. And yet we've all experienced the downside. So you've got to remain pragmatic. You've got to try and look on the bright side of life. But do understand that there will always be something that is likely to go wrong. The trick is to be resilient. The trick is to keep your shoulders down, to keep your head up, to keep your eyes on the ball all the time. But at the same time, do take some time out. Take time out to work on yourself. Take time out to work on your own mental health. And I know that's a big thing these days. Everybody talks about it. Well, I assure you, I think about it at least once a week. I always take time out for my own mental health as well. The amount of stress that can build up without you appreciating it is phenomenal. And most people don't really look beyond their own horizons often enough. But if you do, I assure you, by the time you come back to your own environment and look at the problem you started with, it is always going to be easier to deal with once you've looked beyond the horizons of the problem in the first place. But yeah, there will always be somebody who's going to come along and sort things out and perhaps rain on your parade. Well, be ready for it, be resilient, and try to smile through the pain. Many thanks.
Thanks, Charles. I was just sorting out my microphone there because I'd muted myself. That was absolutely brilliant, and some really, really key messages in there. Charles, in terms of, I think the point you raise around cash versus liquidity is often missed, and a great reminder. But what you've finished on there in terms of the sort of how you feel as a owner manager and the pressure that's on you in these situations and how you cope with that is really important. And it kind of leads on to one of the questions that we've got, which is, I think sometimes what happens in these situations is you don't want to approach somebody like you. So don't take this personally, but it's almost the last resort. And what I want to try and do with this webinar is also encourage people to know when the right time is to approach a recovery or insolvency practitioner, because if you do it at the right time, it's enormously positive and can turn the business around rather than leaving it too late. But I see all too often owner managers do what you described, head down, grafting on, trying to sort it out themselves. And then as they feel the pressure, all that stuff kicks in your brain where you're perhaps not thinking quite as clearly as you might do. Tell us, why should somebody come to you rather than an accountant? And the question is, at what point should they do that?
Okay. Step one, if you've got an accountant, talk to your accountant first. Don't go straight to an insolvency practitioner. If you've got an accountant and they're not doing the job you feel they should be doing, apart from perhaps just writing your books of accounts or doing your bookkeeping, then that might be the right time to talk to an insolvency practitioner, but you need to be quite selective about it. It's very, very, very difficult to get recommendations about insolvency practitioners. It's a good thing if you do, because it generally means they're pretty good at what they do. But it's hard to find friends who will necessarily admit to having used an insolvency practitioner. So finding an accountant first, or a solicitor, because quite often solicitors have these contacts as well, is a good way to find yourself a decent insolvency practitioner. But you've got to trust the person that you're asking for the recommendation in the first instance. It is incredibly difficult if you don't have a good relationship, perhaps with your accountant or your business advisor. And if, for example, you've got into a situation with them where you only touch base once a year because they do your annual accounts, then you've probably not got the sort of relationship that you can rely on to resolve a problem when you get into an insolvency situation. Because apart from anything else, it's highly likely they're also a creditor, and they will want paying for whatever advice and guidance that they give you. So provided you've not got into that situation with your accountant, and provided you've got a good relationship with them, then go to them first. Okay. But there are other people to talk to. And through a lot of business networking groups, it's very easy to say to somebody, do you happen to know an insolvency practitioner? We've got a friend who's got a bit of a problem. I know it sounds like sort of the old cliche, but there's nothing wrong with asking within networking groups. And there's also nothing wrong with talking to more than one IP. If you meet an insolvency practitioner, you need to feel comfortable with them. If you have a meeting with them, they'll all give you the time of the day. Have a meeting with them. Decide if you like them. If you don't like them, it's not about what they tell you. It's about whether you like them. If you don't feel comfortable with them, move on, find another, talk to them. You can do all of this very quickly. Most insolvency practitioners are ready at the drop of a hat, and they don't all start charging as soon as they start talking to you. I would always generally have 2, maybe 3 meetings with any potential client before we get anywhere near looking at an engagement letter. And that is how it should be. Insolvency is a really difficult decision if you've got to consider it. And what you want is an insolvency practitioner who's going to give you honest guidance as to what you should be doing. He won't immediately reach for the first product on the shelf that puts you into liquidation.
Okay, thanks. That's great, Charles. We've got another question here. What is the biggest pitfall that you see owners make which results in the failure of the business? Great question.
It's always doing the same thing without reviewing what works and what doesn't. I think a lot of people get into business because they've come across an idea or they're particularly skillful at something, and they sort of fall into the trap of going, well, this is what I've always done, so I'll continue to do it. I get involved quite often in peer groups. I've always found peer groups to be really, really useful for me. So attending peer groups enables me to sit in a very safe environment, talk to other people who run other businesses, often not in my own industry at all. And we can discuss each other's problems. And instead of actually them saying, you must do this, what happens is the peer group effectively says, if I was you, I might do this, but they will always ask questions about why I'm doing the things that I'm doing. They make me self-review what I am doing. And I think that's a really important thing, because the vast majority of businesses that I do see that fail, they've just been doing what they always do. And as a result of that, they've not been looking around them. They've not been sharing thoughts with other people. They've not even been attending networking groups and doing anything other than trying to sell. And I think a lot of people look at networking groups as sales opportunities. They're not. They're opportunities to work on your business. If you get a chance to sell as well, that's fine. But just having conversations with people about how they run their businesses, what life is like, and finding a few friends. That's definitely it. It's running out of money because they've always done what they've always done and don't actually think about other things they might achieve.
From a sort of personal reflection, it's hard though sometimes. It's hard to step back from the day job, particularly when it's tough, because, human instinct kicks in, doesn't it? And think, I just have to graft harder. And you taking time out, therefore, to go to a networking event is often seen as a real luxury or a privilege. So that's really helpful advice and a reminder of how important it is to step out of the business sometimes to see what the challenges are or the problems are a little more clearly. The other thing that I think has been really helpful, and a couple of people have mentioned, is about this spending money on sales versus elsewhere. And such a great reminder that if you're going to win business, you have to be able to deliver it. And like you, sadly, I know a couple of businesses that have been absolutely stunning businesses in terms of what they do. But they've got too many sales in too quickly, which sounds perverse, and they haven't been able to service them. So in that situation, if you find yourself in that situation, Charles, the question is, how do you get out of it?
Well, a lot of businesses don't get out of it, because by the time they realize they're in that situation, it's too late. Overtrading is a terrible situation to be in. You can drive sales really, really hard, and you know that if you could actually get the money in on those sales, you can actually complete the sale, then you'd be fine. But quite often, just getting the sale completed is beyond reach. And I think the problem is I only ever see people when they've got to that point. And that really means, well, what else can we do here? Well, you look for other business partners. Yes, you've got to try and find some other finance to help you actually secure those sales. But having done that, if you can achieve that, then you've got to say, okay, now time to put on the brakes.
Yeah.
You've got to put the brakes on. And in reality, if that means letting some customers down, then you might actually have to let some customers down. Sure. Don't be afraid of approaching your customers saying, look, I'm sorry, I can't do this.
Really helpful. Thanks. And we're out of time, so I'm just going to wrap us up now. But before I do, one last very quick question, straightforward answer. How often would you recommend people review their financials? Weekly, monthly, quarterly? What is it?
Well, it depends on the size of the business, but a minimum of monthly.
Cool. Thank you. Listen, Charles, that's been absolutely superb. Really, really appreciate it. In terms of wrapping up then and what next and next steps for everybody, as I mentioned before, you can sign up to the UME SatNav service free of charge, and you'll get an extended free period as part of joining this webinar series. You will also get in a follow-up email an action plan to get started with it. Start to think about where those weaknesses are in your business, how you can make it more resilient. We've got some more webinars coming up. So as I mentioned before, please do hook up with those. Share your experience. As Charles has just been saying, knowing that we're not alone and that you're experiencing similar things is often quite comforting. And also the thing that I've seen, particularly with energy usage, is the incredibly simple but brilliant ideas that are going on in businesses in terms of how to reduce their energy costs. So use the hashtag cost of trading crisis on any of the social media channels and share those thoughts. And then please, as I say again, let us know what you think. It's really important to us here at UME that we're getting this right and we're really helping, because that's what we live for. That's what makes us tick. So I'll leave it there. Thank you to everybody for joining, and particularly to Charles for giving up his time. Really, really appreciate it. Bye-bye.
You're welcome. Thank you.